Today we're going to look at the company Ambev, headquartered in Brazil and traded on New York Stock Exchange under the ticker ABEV. Please stay tuned for the important disclosure information at the conclusion of this video. Ambev's history is a story of strategic consolidation that transformed century-old regional breweries into a global beverage powerhouse. While the company traces its deep roots back to the 1880s with the founding of Antarctica, 1885, and Brahma, 1888, its modern era officially began on July 1, 1999. This pivotal merger between Brazil's two largest rivals created the Companhia de Bebidas das Americas, better known as Ambev, establishing a dominant national champion capable of competing on the international stage. The company's growth accelerated through the early 2000s as it expanded its footprint across Latin America, notably acquiring a controlling stake in the Argentinian leader Quinza. A major structural shift occurred in 2004 when Ambev merged with Belgium's Interbrew to form InBev. This transaction integrated Ambev into a global network, though it maintained its local identity and listing on the B3, São Paulo Stock Exchange. The evolution continued in 2008 when InBev acquired Anheuser-Busch to form AB InBev, the world's largest brewer, leaving Ambev as a key subsidiary overseeing operations across South America, Central America, and Canada. More recently, the company has pivoted toward a tech-driven future, launching digital platforms like BEES and Zé Delivery to modernize its distribution and direct-to-consumer sales. Ambev operates a sophisticated, vertically integrated business model that has evolved from a traditional beverage manufacturer into a technology-driven platform. The company manages the entire product lifecycle, from sourcing agricultural raw materials like barley to brewing, bottling, and distributing a diverse portfolio of over 30 brands. This scale allows Ambev to dominate the market by catering to every consumer price point, ranging from value and core national favorites like Skol and Brahma to premium global icons such as Corona, Stella Artois, and Budweiser. The business is strategically organized into four primary geographic divisions: Brazil, Central America, and the Caribbean, Latin America South, covering markets like Argentina and Chile, and Canada. While beer remains the core revenue driver, Ambev has aggressively diversified into non-alcoholic beverages, maintaining a major partnership to bottle and distribute PepsiCo products, and the Beyond Beer category, which includes ready-to-drink cocktails and energy drinks. A defining feature of its modern model is the digital ecosystem. The BEES platform has digitized interactions with over 1.3 million B2B customers, such as small retailers and restaurants, while Zé Delivery serves millions of direct-to-consumer users with on-demand, cold beverage delivery. This digital shift not only streamlines logistics, but provides Ambev with granular consumer data that powers its pricing and innovation strategies across its 18-country footprint. The revenue history of Ambev is a testament to its ability to balance core traditional brewing with rapid digital and geographic expansion. In the early part of this 20-year window, from 2006 to 2012, Ambev experienced a golden era of growth driven by a booming Brazilian economy and the successful integration of Quinza in Latin America South. During this period, the Brazil segment consistently delivered over half of the total revenue, bolstered by the massive popularity of brands like Skol and Brahma. The Canadian operations, through Labatt, provided a stable, high-margin revenue stream that offset some of the emerging market volatility. However, the middle of the decade brought significant challenges as the Brazilian economy faced a severe recession in 2015 and 2016, coupled with a sharp devaluation of the real. This is reflected in the visible dip in USD-denominated revenues during those years, despite the company maintaining strong local currency performance. Ambev responded by pivoting toward premiumization, shifting its focus from volume alone to high-margin global brands like Budweiser and Stella Artois. This strategy proved resilient, allowing the company to recover and sustain revenues even as consumer habits shifted toward more specialized beverage choices. The most recent 5-year period represents a fundamental transformation of Ambev's business model. Following the global disruption of 2020, the company accelerated its digital initiatives to secure its route to market. The launch and scale of the BEES B2B platform and the Zay Delivery consumer app have revolutionized how the company generates income. Today, digital platforms account for a vast majority of its B2B orders in Brazil, effectively turning a beverage company into a data-driven logistics and fintech provider. As we look toward 2025, the revenue streams are increasingly diversified, with beyond beer products, such as ready-to-drink cocktails and non-alcoholic innovations, playing an increasingly critical role in the company's long-term growth profile across the Americas. The financial journey represented in this table tracks Ambev's evolution through several distinct economic phases. In the early years, roughly from 2006 to 2012, Ambev benefited from a rising tide of consumer spending in its primary market, Brazil. During this era, revenue grew consistently as the company consolidated its regional leadership through the Quinça merger. The cost of goods sold remained relatively stable as a percentage of revenue, reflecting the company's legendary zero-based budgeting approach, which rigorously controlled operational inefficiencies. This discipline translated into massive operating cash flow relative to the company's size at the time. A notable structural change occurred in the mid-2010s. The 2015 to 2016 period saw a significant dip in USD-denominated revenues, not necessarily due to a loss in market share, but because of the severe devaluation of the Brazilian real. By optimizing accounts payable and keeping inventory lean, Ambev was able to protect its free cash flow even when net revenues were under pressure. This period also marked the beginning of a heavier investment in sales and marketing as the company pivoted toward premiumization, defending its turf against a rising craft beer movement and shifting consumer tastes. As we move into the 2020s, the financial profile shifts toward high-tech integration. The rise of the BEES B2B platform and Zay Delivery direct-to-consumer app began to impact the contract liabilities and sales and marketing lines. While marketing spend remained high to build these new digital brands, the digitization of the supply chain began to provide more predictable working capital flows. By 2024 and into 2025, the company reached a new revenue peak, bolstered by a more stable Brazilian macroeconomic environment and the successful expansion into the beyond beer category. While Ambev utilizes stock-based compensation to align management incentives with its owner-operator culture, it is not an overly dilutive factor in its cash flow story. The table reveals a corporate philosophy centered on capital allocation discipline, a hallmark of the 3G capital-influenced management style that has guided Ambev since its inception. By examining the relationship between free cash flow, adjusted for stock-based compensation, and the subsequent deployment into dividends, debt repayment, and acquisitions, we can see how the company evolved through three distinct financial epochs. In the initial decade, spanning from 2006 to 2012, Ambev was in a consolidation and expansion phase. This era was defined by strategic acquisitions, most notably the full integration of Quinça in Argentina and several regional craft and premium beverage players. Despite this expansion, the company maintained a high payout ratio, often returning nearly 80 to 90% of its free cash flow to shareholders via dividends. This was possible because the business was generating massive amounts of cash from its core Brazilian operations, which required relatively low capital-intensive maintenance compared to its high-growth revenue profile. During this time, the financing debt was kept at manageable levels, rarely exceeding 1.0x EBITDA, as the company preferred to fund its growth through its own internal cash generation rather than leaning on capital markets. The middle period, from roughly 2013 to 2019, represents a pivot toward defensive stability. As the Brazilian economy faced severe headwinds and currency devaluation, Ambev's USD-denominated free cash flow became more volatile. In response, management doubled down on debt reduction. You can observe the financing debt rose steadily, declining year over year as the company systematically paid down high-interest local and international loans. By the end of 2019, Ambev had effectively become a net cash company, meaning its cash and short-term investments exceeded its total interest-bearing debt. This conservative stance was a strategic choice to protect the dividend stream. Even in lean years, the company rarely cut its payout, instead utilizing its deep cash reserves to bridge any shortfalls in annual cash generation. The most recent 5-year cycle, including the projections for 2025, highlights a new era of digital and platform-based growth. While strategic acquisitions have slowed in terms of large-scale brewery buyouts, the company has shifted its strategic acquisitions capital toward technology and logistics startups that power its B's and Z delivery ecosystems. Share buybacks have also become a more frequent tool in the toolkit, particularly when the stock price has faced pressure from macroeconomic sentiment despite strong underlying fundamentals. Today, the balance sheet is one of the strongest in the global beverage industry, with a massive cash pile that provides the optionality to either pursue a major transformative acquisition or continue providing one of the most reliable dividend yields in the emerging market space. This long-term track record of returning capital while simultaneously deleveraging has made Ambev a cornerstone for value-oriented international portfolios. Ambev's leadership transitioned into a new era on January 1, 2025, with the appointment of Carlos Eduardo Lisboa as Chief Executive Officer. He first joined Ambev in 1993. He has spent over 30 years climbing the corporate ladder, previously leading major regional zones including Middle Americas, Canada, and Latin America South. The ownership structure of Ambev is heavily anchored by its parent company, Anheuser-Busch InBev, which maintains a controlling stake of approximately 62%. This ownership structure provides strategic stability but means that the general public's influence on governance is somewhat limited. Institutional investors, such as mutual funds and hedge funds, hold roughly 26% of the shares. The remaining 12% is held by retail and general investors. The liquidation value is estimated at $2.4 billion or 15 cents per share. Let's build a scenario-based dividend discount model. In the base case, Ambev maintains its steady compounding nature. This scenario is driven by the continued premiumization of its portfolio, where high-margin brands like Spaten and Michelob Ultra increasingly replace standard lagers. The B's B2B platform matures from a distribution tool into a high-margin data and credit provider, stabilizing revenues even during local economic downturns. Revenue growth tracks slightly above regional GDP, while the company remains a dividend hero of the emerging markets, steadily growing its payout. The bull case envisions Ambev successfully transforming into a pan-regional tech powerhouse. In this story, the company leverages its massive cash reserve to dominate the beyond beer and non-alcoholic categories, which grew at over 30% in 2025. Strategic acquisitions in high-growth Central American markets or tech-adjacent sectors, like fintech services for small retailers, accelerate growth beyond traditional brewing. Conversely, the bear case considers a future where persistent macroeconomic volatility and shifting consumer habits erode the moat. In this narrative, prolonged hyperinflation in markets like Argentina and tax regulatory shifts in Brazil, such as the potential end of interest on equity tax benefits, severely squeeze net margins. If younger consumers pivot away from traditional beer faster than Ambev can scale its beyond beer offerings, volume declines could lead to stagnant revenue growth. In this defensive posture, capital allocation shifts away from growth and buybacks to focus strictly on preserving the balance sheet and a minimal mandatory dividend. In the bull case scenario, we assume the following: revenue growth at 5%, operating cash flow margin at 36%, capex growth at 6%, stock-based comp growth at 8%, dividends growth at 7.5%, stock repurchase at 5%, acquisition spending in the next 20 years at $15 billion. Stock repurchases assumes price-to-sales ratio of 3. With this discounted at 7.5%, dividend model yields $3 worth of value per share in 20 years, $5 in 30 years, and $7 in 40 years. In the base case scenario, we assume the following: revenue growth at 3%, operating cash flow margin at 32.5%, capex growth at 4.5%, stock-based comp growth at 6%, dividends growth at 4%, stock repurchase growth at 2%, acquisition spending in the next 20 years at $5 billion. Stock repurchases assumes price-to-sales ratio of 3. With this discounted at 7.5%, dividend model yields $2 worth of value per share in 20 years, $3 in 30 years, and $3 in 40 years. In the bear case scenario, we assume the following: revenue growth at 1%, operating cash flow margin at 28%, capex growth at 2%, stock-based comp growth at 3%, dividends growth at 2%, stock repurchase growth at 0%, acquisition spending in the next 20 years at $2 billion. Stock repurchases assumes price-to-sales ratio of 3. With this discounted at 7.5%, dividend model yields $2 worth of value per share in 20 years, $2 in 30 years, and $3 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.